Hey everyone, this is Rob Kings from goldsilverpros.com. It's Monday, August 3rd, 2020 at about 9:15 p.m. I just got back from a workout and I wanted to do a quick video for you guys because we're seeing some interesting activity in the gold futures market. And I think it's worthwhile to do a quick video on that. So I'm going to share screen and we're going to show you guys what we're seeing. So as we see here at goldprice.org, we're seeing some pretty good numbers on both the gold and silver price. I'm not going to get into the detailed charts here. I just wanted to show you the ranges of trading in. Remember the last video on silver I did, we bounced up against a 2450 resistance line and we're going to range trade under that for a little while before it punches through. I still think we'll get through that 24 and the next resistance level will be at the 26 from 2450. But again, we're still underneath that line. But this video is really going to be about gold, and gold's trading still at an all-time high, or pretty close to an all-time high. Definitely higher than the 2011 price. I think it got close to touching 2000. We're still sitting up at 1977, which is a good number. And I think that could rise. I think we're going to challenge 2000 here maybe this month. And I'm going to show you why based upon the information we're seeing in COMEX futures market. So here I want to discuss what we're seeing for the month-to-date delivery notice. So this is the month-to-date delivery notice on COMEX. This is the gold futures right here. And we're looking at the intent date. Now I want to explain what the intent date is. The intent date is there's a certain day for that month, for the August month or the July month or the September month, that you can say, I'm issuing a notice to take delivery of the gold. And that intent date has a certain date it can begin and end. So let me show you what that is real quick on this neat little chart from CME Group. So the first intent day is basically 2 days before the first day of trading for the month. So what does that mean? If we look at our calendar, the first trading day of the month for August is the 3rd because it falls on a Monday. The first and the second are on the weekend. It's not a trading day. So if you backtrack 2 business days from the first trading day of the month, that will leave you with the 30th. So you'll see the first notice of intent to take delivery of the gold is going to occur on the 30th, which is what happens on this chart. Okay, so that's what we have with the first intent date. The last intent day is the day before the last trading day of the month. Last intent day of February would be the 27th, because of course 28th would be the last trading day, assuming it fell on a business day. So for August, the last trading day is going to be the 31st. So 1 business day before that would be the 28th. So we'll basically have almost 4 full weeks, 3.5-ish weeks before the last trading day of the month for August. Keep that in mind when we look at the delivery notices. We're literally sitting on the 3rd day in August that we could have issued an intent to take delivery, and we still have the vast majority of the month left. So let's go to the numbers. The first day of intent to take delivery on an August contract, we had 32,732 contracts of 100 ounces. So that basically is 3,200,000 ounces standing for delivery on the COMEX. If you multiply 32,000 times 100, in fact, let's do that real quick. We're going to do 32,732 times 100 ounces. 100 equals 3,273,000 ounces. And we multiply that by 1977 gold price per ounce. We get $6.4 billion worth of gold standing for delivery on the first day. And then the second intent day of the month, 2,142 contracts. And now the third, which is today, 5,038 contracts. So we're sitting at a total of 39,912. So let's clear this out and see what 39,912 gives us times 100 ounces of gold times the 1977 price of gold per ounce. So we're standing for delivery so far in the first 3 months of almost 4 million ounces at $7.8, $7.9 billion standing for delivery. Now, where does that stand up to previous months? How does that compare to what we've seen so far in 2020? So we're looking at the year-to-date delivery notices now for gold, the gold futures, and I came down here to the bottom to the totals. So you can see last year in December, it was 14,761. So that's a pretty sizable number. But overall, it's usually not that high. We got in January 2716, 8234, 2914. Then it jumped up in April. Of course, we had COVID hit the United States in March. There's the fear trade and the safety trade into gold. So immediately in April, we saw people stand for delivery, almost 32,000 contracts. Then it died down a little bit as the numbers got a little better in COVID. So it went down to 10,277. And then in June, it spiked back up because they started talking about a second wave. They started talking about some increased deaths in the United States. So June, we had a massive month, 55,102. July, it settled down a bit, and now we're back in August. So you can see the pattern here: high number, a little bit of lower number, high number, a little bit of lower number, high number. But average, the last few months, we've had very, very high numbers compared to what we typically see. And remember, we're only on the third trading day, or the third intent day this month. It started with Thursday, Friday, and today, if you remember, based on that handy dandy little chart we had. So we still got most of the month of August to go where people can stand for more delivery. We're very early in this process. So if you go back to the total chart, and I know I'm flipping charts here, but this is the year-to-date delivery notice. We're only 3 days in and we're at 39,912, whereas the whole month of June, we had 55,102. It's quite possible we could break the June record of 55,102 because we had so many people come in literally on the first darn day looking for physical delivery of gold ounces. So I think I've hammered on that enough, but I wanted to give you the picture of what that basically looks like. So what happens if they remove all the gold off of COMEX? See, let's say this number keeps climbing throughout the month and they start taking a ton of money off the COMEX. What happens? What do we do in that case? Well, there's a potential that they may not have to deliver the gold. I don't think we're in panic mode right now. I think there's enough gold on COMEX they can satisfy 40,000 contracts of 100-ounce gold, 4 million ounces of gold. You know, I think they can do that for a while, but we're getting closer. If you look at the trend is definitely up since COVID. This is not a normal market. This is a market driving people into safe assets, and they're trying to get it however they can. We talk about the mine closures, the supply chain issues where people were having trouble getting gold. That's where we saw the number spike on COMEX. They're trying to get the gold off of COMEX because they know that there's some in the warehouse and they can do it through futures. They can buy that long future contract. They can immediately notice for delivery like they did here in August, a massive amount. And they're going to say, hey, I have this intent to take gold. The one way that COMEX can kind of get out of this is force majeure. So in chapter 7 on CME Group of basically a handbook of trading, there's something called declarations of force majeure. That's section 701. So we're going to go down to 701 here and we're going to read what force majeure is. Declarations of force majeure. If a determination is made by the chief executive officer, chairman, president, chief operating officer, or chief regulatory officer, or their delegate, that delivery or final settlement of any contract cannot be completed as a result of force majeure, he shall take action such as he deems necessary under the circumstances, and his decision shall be binding upon all parties to the contract. In other words, they can do something outside of the normal scope of business, the normal scope of trading, by declaring force majeure. They can do something outside of doing that, meaning they may not have to settle the actual physical gold ounces. It goes on to say that the exchange shall notify the CFTC of the implementation, modification, or termination of any action taken pursuant to this rule as soon as possible after taking it. And it shall be the duty of the members, clearing members, regular facilities, and metal service providers to notify the exchange of any circumstances that may give rise to a declaration of force majeure. So the clearing members are basically on either side of the trade saying, yes, we're going to clear this. We're going to actually facilitate the physical trading. So if they basically say we don't have it or we can't provide it, they could declare force majeure. It's what it says clearly here in chapter 7 under the rules of the exchange. And it says, nothing in this rule shall in any way limit the authority of the board of directors to act in a force majeure situation pursuant to Rule 230K. So essentially they're saying we can get out of actually delivering the metal. Now that's not a normal thing to do. They don't declare force majeure every month that they may have, you know, a substantial amount of people coming to take delivery. But given this trend is very high due to COVID and the mine shutdowns and the lack of available big stocks of gold, a lot of people have been of the opinion that maybe they will declare force majeure. So force majeure, I wanted to give a common definition of what force majeure actually is. We read it from the manual, but what does force majeure mean? Well, it says here in Wikipedia, it's a common clause in contracts that essentially frees both parties from liability or obligation when an extraordinary event or circumstances beyond the control of the parties, such as a war, a strike, a riot, or a crime, epidemic, see, it's right here, epidemic or pandemic, or an event described by the legal term act of God, prevents one or both parties from fulfilling their obligations under the contract. In practice, most force majeure clauses do not excuse a party's non-performance entirely, but only suspend it for the duration of the force majeure. So essentially what they're saying here is an epidemic or a disease like COVID-19 could cause a force majeure. And through the CME group regulations, they can declare force majeure. It's any of these people, the chief executive officer, chairman, president, chief operating officer, and if any of the parties in the actual conduct of doing the trades, like the clearing members, the facilities, mental service providers, bring it to the attention of these people at the top, they can declare force majeure. So I did a little bit of research, and Shearman and Sterling is a law firm in which they actually have looked at force majeure on COVID-19, saying, could COVID-19 be a force majeure event? And they have an opinion here. It says, following the rapid spread of the novel coronavirus, first reported in Wuhan, China, at the end of 2019, the World Health Organization declared COVID-19 to be a pandemic. Okay, pandemic, epidemic. Epidemic is like a pandemic in one area, and when it spreads to other areas, it's called a pandemic. So epidemic, pandemic are basically synonyms, but pandemic is bigger. It's spread further than just an epidemic. So definitely that would qualify under the common term of force majeure, that's a common cause in contracts that frees parties from liability, i.e. the ability to actually deliver the gold or the silver or the aluminum or the wheat or whatever the futures contract is for. And it says, in this note, we consider how force majeure provisions in commercial contracts and related common law doctrine of frustration may be engaged in the context of COVID-19 outbreak. So the common law doctrine of frustration, I'm not going to go through explaining that, but if there's not an explicit force majeure clause like there is here at the CME group, the doctrine of frustration is a common law, like an English common law equivalent to that, saying, well, we still have a remedy for that, even if it's not specific in the contract. So even if they didn't have the one here in the CME group, the force majeure, which I'm trying to get to, but my recording software is not going to let me get up to that tab. Here we go. Sorry about that, guys. Even if they don't have a specific force majeure contract, you can still do the common law doctrine of frustration. And this goes back to English common law. So this is part of American trading since the beginning of the country. It says a force majeure event refers to the occurrence of an event in which is outside the reasonable control of a party and which prevents that party from performing its obligations under a contract. English common law has no general concept of force majeure, save for the limited doctrine of contractual frustration, which is addressed below. In other words, there's a common law equivalent, even if it's not specified specifically in the contract. A party's ability to claim relief for a force majeure event therefore depends upon the terms of the contract and the force majeure provision in particular. Force majeure provisions are express terms and will not ordinarily be implied into contracts governed by English law. A party affected by such an event of force majeure would typically be relieved from performing the obligation affected for the duration to the extent affected. So in other words, they wouldn't have to deliver the metal for as long as we had a COVID-19 pandemic. Remember, pandemic, epidemic is common causing contracts for declaring force majeure. And it says events capable of constituting force majeure. I'm going to read these bullet points. The test, the legal test, meaning how they would determine force majeure. For force majeure usually requires the satisfaction of three distinct criteria. The event must be beyond the reasonable control of the affected party. Well, it's a virus. It's not like the exchange could control that. The affected party's ability to perform its obligations under the contract may have been prevented, impeded, or hindered by the event. Okay, so let's say COVID-19 shuts down some of the metal refineries, the delivery of metal because lack of flights and lack of transfer, the lack of mining, replenishing the current supply. The stocks fall on COMEX. Definitely you can see it passing that part of the test. And the affected party must have taken all responsible steps to seek and to avoid or mitigate the event. So what could they possibly have done? I mean, they could go dig the gold out of the ground. They could go to the market and pay a higher price and try to get additional inventories into COMEX. But that's the free market. And if the free market's not giving up their gold, which apparently they're not, people aren't giving up their gold. They're trying to obtain it in these reports, as we can see. They're not giving it up. Then it seems to pass that as well. So based upon Shearman and Sterling interpretation of force majeure and COVID-19, plus the commonality of force majeure, which includes epidemics, plus the rule that we see in the CME group's trading practices, leads me to believe that they could and will declare a force majeure if people continue to take gold out of the COMEX. So in other words, certain amount of people are going to get gold out of the COMEX. Once that gold stock on the COMEX comes really far down, that's where we could see them declare force majeure. I don't know if they will, but I wanted to talk about it because I could see this coming in a few months. If these trends continue, in a few months, there's not going to be a whole lot of gold in the COMEX. They're going to be talking about a potential default. I don't think they want the COMEX to actually default. I think they're going to declare a force majeure. And even if they didn't have force majeure, they could go to the English common law doctrine of frustration if they really absolutely wanted to. I think they have kind of two outs here. So that may be what we see in the metals market. Now, what you want to know as an investor, what the heck happens? What happens to the gold price if somebody declares force majeure? It depends on the perception. People in the know are going to understand that that means there's not a lot of gold. It's going to make it immediately more valuable. I think that would punch the price up. But I think how they manage the perception of that event and say, oh, it's COVID-19, blah, 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 and we'll get back to normal eventually, could sort of limit some of that upward movement. But I think there are a lot of people who, because of the other problem, not only COVID-19, but the debt problems and the unemployment and stuff like that in the United States, I think it's gonna really push the gold price higher. I don't think it'll push it to $5,000 gold. I think that would take a massive sovereign debt default and a banking crisis across the world, but it could push gold $2,200 range if they declared force majeure. So again, force majeure would be very bullish for the markets. So that may be coming down the pike. I don't know that it is, but it's definitely a potential situation. And that's why I've been watching the future market so much. When you see so much silver and gold coming off, people standing for delivery, you have to start talking about, what could the CME do here to basically say, we don't really have the gold, and so we can't settle those gold contracts for you. And again, that'll depend upon these people that are doing the daily operations to tell the executives up here, we're having an issue, and then they declare it, and then pretty much people are expecting that would be a legitimate excuse. So if you're wanting to get your gold and silver, you want to get it now because it's being drained everywhere. It's being drained from the retail outlets. It's being drained off the COMEX. The smart money is moving in. And so if you want to get your position, you want to get it now. Don't wait for the price to drop, because even if the price drops temporarily and it turns out that there's no gold to be had, it doesn't really matter that price drop, and that price is going to spike anyway. I wanted to take a moment to invite you guys to my conference, which is occurring Thursday, Friday this week. It's the North American Monetary Metal Summit. I'm going to have many, many speakers and many sessions here over 3 days. And we'll have a little get together 4 p.m. on Wednesday, Central Standard Time with me, where you can meet me and talk to me during the conference, and sort of a little opener to the conference. But then we have this agenda of all these different speakers, headlined by David Morgan of the Morgan Report. And on Friday, we've got some additional speakers for you as well. On each day at 12 p.m. Central Standard Time, we're going to have live Q&A sessions where people will come in to answer questions. So on Friday, it's going to be Ann, Greg, and myself. And on Thursday, we're going to have all of these people. Chris Marcus, Arcadia Economics, Dave Kranzler, Rafi Farber, Don Durrett, and myself will be answering questions. And who knows, maybe some of the other presenters will step in as well. This is a completely free conference for attendees. We're very fortunate to have sponsors help us pay for this. So you can click this little register button here, get in for free, and enjoy the conference. And these conference sessions will eventually be posted to YouTube. But if you want to get the information timely, especially with what's going on right now, this is very timely. You don't want to wait on this information. You can come to the conference this coming Thursday and Friday, August 6th and 7th, and we'll have tons of information for you on the gold markets, on the economy, and we'll answer tons of questions for you. I think it'll be really, really helpful. Okay, guys, just got off my workout. It's late at night. I'm going to go ahead and take care of some business, but wanted to bring you an update on what's going on in the gold futures market. Till next time, this is Rob Keens at goldsilverpros.com.